Good morning and welcome to part 2 of Gabelli's Value Investing Seminar. We are honored to have Professor Bruce Greenwald of Columbia University School of Business here with us. I'm Joy Gardner, a member of Gabelli's London office, and I have to say it's great to see so many of you here again today. Yesterday we went over the principles and merits of value investing, and today we will dig deeper into the specifics, and I encourage you all to participate in an active dialogue, so please don't hold back on any questions as and when they come up. With that, Professor Bruce Greenwald.
Apparently there were unanswered questions yesterday. I can't answer them if you don't ask them. And my predisposition, again, this is something if you've ever taught, you'll know, that if a course goes well, you never see any students in your office. If it goes badly, they're all over you like flies. So my predisposition is to think that there are no questions out there because I've been so crystal clear. On the other hand, if they're really out there, you ought to ask them, because in some sense today is going to be a review of the material of yesterday to provide you with precisely that sort of opportunity. And given that you've made the effort to be here in this terrible weather at this time of the morning, you deserve the opportunity to ask those questions. What I want to talk about, again, we talked about a sensible investment process. I want to talk more this morning about the details of that process, and then I want to talk after the break. So first about the details of that process, and after the break what I'm going to talk about is how you assess competitive advantages and the quality of businesses, because that is probably the most important sort of review that you're going to do of the various decisions that you've made. When you think about search, we talked briefly yesterday about there are some securities that nobody can value effectively. And when you have a search strategy, you've got to not pretend that you can. And I cited the example of Microsoft, and I thought it would be useful just to identify what securities are likely to fit into this category, to go through the sense in which there's just no way you're going to be able to evaluate Microsoft. This was done in 2000 when Microsoft was trading at 110, which was 80 times earnings. At that point, Microsoft was not paying any dividends. But I'm going to make the assumption that suppose they started paying dividends between 2000 and 2010 at a rate of 50% of their profits, which they still have not done, although they've done something closer to that than they'd done at the time. Second thing I'm going to assume, because it's the best assumption we can make, is that the growth rate in sales was between 2000 and 2010 going to be about what it was in 2000, which is 40% a year. To give you an idea of what that means, it means that by 2010, Microsoft would be 28 times as big as it was in 2000. And right away, just that tells you something about the range of possibility that you've got to cope with if you're going to understand the future of Microsoft. Then I discounted actual payments by 15%, because presumably for a risky stock like Microsoft in 2000, when interest rates were substantially higher than they are now, you'd want to get a return of something like 15% on your investment. What you'd see between 2000 and 2010 is dividends. And based on these formulas, we could calculate what those dividends are and take a net present value of those dividends. Anything else that you're getting depends on conditions from 2010 forward. If you discount these 50% dividends that are growing at 40% a year, the discounted value, the net present value of the dividend payments you could expect is about 15% of the price that you're paying for the stock, which means that 85% of what you're paying for is based on whatever it is that's going to go on out here beyond 2010. And that's a calculation that I think is worth doing for any stock. Because in an environment that's changing as rapidly as the personal computer market, to think that in 2000 you had a good idea of what was going to happen in 2010 required a degree of hubris that suggests you should really be in the Billy Graham saving souls business, not in the business of investment. So it's a calculation that's worth doing. It's worth asking the question, how much of the return are you going to anticipate? Can you reasonably anticipate? And how much in the near-term future? And how much of it is going to happen in the far-term future? Now, there is another common investing, what I think of as mistake, that is related to this kind of calculation, which is people say, they're going to have 2 good years. I know that. Therefore, I'm going to pay 40 times earnings. 2 good years in a stock that's trading at 20 times earnings is 10% of what you're paying for the stock. That means 90% of what you're paying has nothing to do with that short-term earnings forecast. It has to do with a judgment that's implicit, and implicit judgments tend, for reasons we talked about yesterday, not to be good judgments in how that company is going to be valued. So that the first thing is, when you think about where it's possible to do valuation effectively, you want to think first about this distribution of payoffs and what your forecasts that you think you can make say about the fraction of overall valuation that you're explaining. That's just a small point that I think it's worth making, and it's a point if you're not an investor yourself, but you're choosing investment managers, that you would hope that a professional investment manager would be aware of. The second thing I thought it would be useful to show you is the actual studies that support the statistical numbers that I gave you in summary form. That is, the cheap stocks outperform by about 4%, disappointing stocks outperform, and so on. This is one of the earliest of these studies. It was actually published about 1984. You'll see the data went up to 1982, but again, this has been replicated since then because these studies tend to get done over and over again. What these people did, and this is a guy called Richard Thaler, who's now at the University of Chicago, and a guy called Werner de Bont that's at Cornell, what they did is they picked a year, like 1933, say. They looked between January 1st, 1933 and January 1st, 1932. They looked over the past year and they said which stocks have performed best over the past year and which stocks have performed worst over the past year. They then formed a portfolio of the 10% worst performing stocks and a portfolio of the 10% best performing stocks. And they looked from 1932 to 1933, which is in the coming year, at which of those portfolios performed best. And the measure they used was the performance of the bad stock, the poorly performing stock portfolio, minus the performance of the good stock portfolio. They did it first for 1-year disappointments. And this is the curve that shows the future return difference between those two portfolios. And it shows actually something important about the nature of disappointment. What this shows is these are months here from the date at which the portfolio is formed. Over the next 12 months, the good performing stocks outperform the disappointing stocks. So if you consider disappointing to be just a 1-year horizon, you should stick with the good non-disappointing stocks, not the disappointing stocks. This, by the way, is a phenomena that shows up in all these studies. In the short term, returns are positively serially correlated. Momentum, there is a lot of statistical support for in the short term. The reason value investors are not concerned about that is, of course, we're long-term investors for tax and other reasons. And you'll notice that in the long term, that is from 12 months to 24 months, there's no difference between the performance of the 1-year disappointing portfolios and the 2-year and the 1-year pleasing portfolios, if you will, non-disappointing portfolios. Then they redid the study, and they looked at stocks over the prior 2 years. So if they were looking at January 1st, 1933, and forming a portfolio, they looked at the stocks that had performed worst and best from 1931 over the past 2 years. So they looked at 2-year disappointments. And again, they looked at the difference between the well-performing and the poorly performing portfolios. And that's the second curve here. And you'll notice that in that case, you start to see significant outperformance by the disappointing stocks. That by the end of 2 years, they've outperformed by almost 6% a year. They're about 12%. Your portfolio would be 12% higher in the disappointing stocks than in the stocks that had done particularly well. Then they went back and they did it again with 3-year disappointments. Oh, this curve, you'll notice that this curve is always above the 0 line. That means that the return on the portfolio of disappointing stocks minus the return on the portfolio of successful stocks is positive. That means the disappointing stocks are outperforming the successful stocks over the past. If you define success and disappointment over 2 years, it's always positive. After 12 months, it's the least positive, but in the longer term, you'll see it's strongly positive. This is about 11 to 12% excess return from the disappointing stocks. Does that?
What is it that you're using to define sort of investment?
Again, you look over the last 2, in this case, we looked over the last year and said which stocks had the highest return, dividend plus capital gains, versus the stocks that had the lowest returns. Okay, that's one over the past year. These portfolios were selected over 2 years. This is the graph for 3-year disappointments. They looked over the prior 3 years. Now, there is actually a lesson here for all these studies, which is that slightly disappointing is not enough. When we talk about cheap, and you'll see that in a second, when we talk about disappointing, when we talk about obscure as the basis for statistical portfolio building, it's got to be very disappointing. It's got to be very obscure. It can't be that this stock is just down 30% in the last month, because then the momentum is going to take over. It's got to be 2 or 3 years that this stock is spent breaking the hearts of investors. When we go to cheap, again, it's going to be the extremely cheap stocks that you have to hold your nose and be willing to invest in to get these higher statistical returns. Are there any other questions about this? Yes?
How long does this cycle last? Because then obviously these are the best performing stocks.
Right, no. You rebalance the portfolio every 2 years, 3 years, or 1 year. And that's a good question because it's going to be much more important in the data I'm going to show you next. So there is rebalancing that takes place. You don't just buy the 1931 disappointing stocks and hold them forever. You hold them for 2 years and then you form a new portfolio.
How much of portfolio of underperforming stocks includes, say, Chapter 11 stocks?
Hold that thought because I think when I show you the next data, remember, these are just stocks that have gone down a lot. They may or may not be in Chapter 11. They may have been glamour stocks that stopped being glamour stocks, like Microsoft, which is now trading at, what, $23, $27 a share, down from 110. So they may be disappointing in that sense. These are not necessarily the ugly stocks. The best measure of that is a study done by Gene Fama, who is the father of efficient markets. And this is a typical table that he's done from a paper that he published in the early 90s that he's still struggling with the results of. What he did is something slightly differently. At the end of every month, he formed portfolios. At the end of the month, he formed portfolios of stocks that were the lowest book to market, which is the highest market to book, and the highest book to market, which is the lowest market to book. Why he did it that way as book to market, only he knows, since most people are used to thinking of market to book. That means that these stocks down here are the glamour stocks. These stocks up here are the cheap stocks. These are the expensive stocks. These are the cheap stocks. He formed portfolios at the end of every month, and he did it for each decile of stocks. He also did it for small cap, this is small market equity, to large cap stocks. In this case, he changed the portfolio at the end of every month. So there's a lot of trading going on here, and some of the statistical value investors actually do rebalance the portfolios every month. The first thing you want to look at is the difference in return between the high market to book and the low market to book stocks. He also looked in the body of the table at the combination. But you'll get the message looking at these numbers. These numbers are monthly percentage returns. So over the period that he looked at, the average monthly return for all stocks was 1.2%, or about 15% a year. 15 to 16% a year. That's because it's with compounding. If you just multiply by 12, it's about 15. It's a little higher than that. The glamour stocks had average monthly returns of 0.64%, which is annualized out at about 7.5%. The ugly stocks had monthly returns of 1.63%. That's almost 1% higher per month than the glamour stocks. And that's the sort of results you see. Now, it's in this case that the nearly bankrupt ugly stocks lie. Although if the book value is low enough, you could actually get a high market to book. But usually the ugly bankrupt stocks will be down here, not just the disappointing stocks. Rebalancing once a month, the difference in the returns is not 6% a year, it's 12% a year. It's an enormous difference. But look at the pattern of the differences. When you go from the extreme, the 10% most glamour stocks, to the next, there's a difference of 0.3% a month, which is almost 3.6% a year. At the upper end, when you go from the 8th decile to the top decile, again you get another fairly big difference. But look at what goes on in the middle. There's not much change in returns. The action is coming from buying extremely cheap stocks and staying away from extremely expensive stocks. So what you're going to be doing to get this extra 1% return is predominantly concentrating down here on the really ugly stocks versus up here on the real glamour stocks. Again, it's just like the last example I showed you. Cheap doesn't get it. To get these excess returns, statistically, you've got to do really cheap. Disappointing didn't get it. It wasn't disappointing for a year that was your friend. It was disappointing for 2 or 3 years. The same thing applies to market capitalization stocks. The small market cap stocks, and again, he picked small market cap at the end of every month, and he rebalanced the portfolio monthly. The small market caps, which includes, by the way, the companies near or in bankruptcy, because they don't tend to have a lot of value in their stocks, returned almost 1.5% a month. The high market cap stocks returned under 1% a month. But again, look at the central range. It's from 0.22 to 1.06. The full difference is much more than that, but the difference appears at the extremes. It's extremely small stocks. Ideally, there's a kid who set up a fund. He was our lab rat. Mario Gabelli, among others, and myself put him into business. We put him into business because he wasn't a genius, but he was very disciplined. And he had a strategy of buying companies that had market caps of 10, 15, $20 million or less, which means there was no competition from the big investment funds because they can't put enough money in that to make it worthwhile. And there are a lot of people dumping stock. He's been in business now for just over 5 years. He's outperformed the market by about 23 or 24% a year. His average return is about 21, I think, and the market is flat to slightly down. But what he's really doing is operating at the really extreme low end here on the pink sheet stocks. So again, the message is if you're going to do statistical value, it's going to be extreme statistical value. It's not going to be the bottom half of stocks by price-earnings ratios, which is often the definition used in the newspapers. It's going to be the bottom deciles. Are there any questions about that? Because that's a fairly important point. It means to take advantage of those psychological and institutional regularities that we've talked about. You've really got to hold your nose and buy the truly crappy stocks. Yes?
One question on those numbers, I think the point you made earlier is that if you look at the bottom 3 deciles, the spread is actually not that wide. So you could almost own the bottom third.
Yeah, in some of these tables, that's true.
On the smallest area without...
Well, if you look at the size, the difference here between the second decile in smallness and size and the 8th decile is just 0.14. It's 0.08 minus 1.22. The difference between the second smallest and the smallest decile is 0.25 all by itself. This difference is bigger than the whole range of difference there. These differences down here are, again, about 1.7, which is just about the same as the range for the rest of it.
So you want the smallest, but not necessarily the absolute cheapest?
Not necessarily the absolute cheapest, although it is towards the bottom end here. But you do want to stay away from the absolutely most glamorous. Yes, sir.
If you did this and you screw that for the chapter 11 type, really ugly stocks, what then happens?
All right, that's what really we talked about yesterday, and it's worth repeating. When people try and get cute and really look at the companies, mostly they do worse than these statistical models. Because all of a sudden, all those instincts against loss aversion and the things we talked about, and I'm going to run a little experiment with you here in this room about that, come into play and they say, well, this stock is really cheap, but it's really ugly and I don't want to own it. And the classic case of this is, as I said, the data that I know is Sanford Bernstein, that when they do the combination of their analysts' work and this kind of model, and they have very sophisticated models that have multiple indicators that I'm going to talk about in a second, they have outperformed the market by 3% a year over the last 22 years. That's a huge outperformance. They calibrate their models and their performance not just against the market, they calibrate it against simple market-to-book based models. If they bought on the basis of market-to-book, they would have outperformed the market by 3.9%. So by doing things the way you're suggesting, the evidence is a sophisticated operation like Sanford Bernstein with 200 analysts loses an extra 1% as opposed to these. It's very hard to beat these numbers. Yes?
Just for a matter of clarity, what would be a relatively low book market?
It obviously varies over time. That, remember, these are deciles. If you were back in, say, the 1970s, this is a period from 1963 to 1990. If you're in 1974-75, the lowest decile book to market, I'll bet you, is about 50%. Or market to book is about 50%. The market is way below the book. If you're up at the end of this towards 1990, your probably lowest decile is probably 0.8. So it's an 80% market to book. It just varies over time. But consistently what you're doing in this table is you're buying the ugliest stocks that are available.
Isn't the
people have looked at these strategies. And if you have diversified portfolios, because if there are 2,000 stocks here, these are off the crisp tape, so none of the stocks that this kid buys are here because they're just not computerized data series for the prices. He's way below the radar on this. But if you perform a diversified portfolio of these stocks, and you actually track what is probably the wrong measure of risk, but it's the one that people publish, which is the variance of the portfolios, these small stock and ugly portfolios have much lower variance than the glamour portfolios. It's the glamour stocks that go bad that have the high variance. So when people have actually looked at the issue of risk, provided you have a portfolio of bad stocks, it turns out the bad stocks on average turn around. And they turn around because you've got asset protection and other things without anything like the damage that you get when a Microsoft goes bad. So the available evidence, and it's really what these people found most disturbing, is that these high return portfolios are also, in terms of the conventional measures, the low risk portfolios. This is an example of something that is useful to do. You notice that what we've really talked about are essentially, or what I've talked about so far, is single indicator statistical construction of these portfolios. I've looked at low market to book separately from low market capitalization. I've looked at disappointing by itself. This is a study that looked at glamour stocks versus value stocks in two dimensions. One dimension was cash flow to price. So the glamour stocks have low cash flow to price. The value stocks have high cash flow to price. And here, the stocks weren't divided into deciles. They were divided into thirds. But a second variable was used. The second variable was the growth rate in sales, on the theory that fast-growing stocks are attractive stocks that are apt to be overvalued. And again, it's just the third decile. So this is the extreme set of glamour stocks that I've circled here. That it has the lowest cash flow to price and the highest growth rate in sales by thirds. Those stocks underperform the market in this sample by about 3.3% a year. Now, also in this study, they're not doing the monthly rebalancing. So there's not as much trade going on. These stocks are the cheapest in terms of they have the highest cash flow to price, the lowest growth rates of sales. They outperform the market by 5.4%. And again, that's picking the portfolios annually. The difference between the two, you'll notice, is about 9%. It's 8.7 if you add those two things. That is smaller than what you saw in the previous slide, where the difference between the extreme glamour and the extreme value stocks, that is the high market to book and low market to book stocks, was on the order of 12 or 13% a year. That's a reflection of two things. Part of that, about 1 to 2%, is that these portfolios are formed annually, not monthly. Who's the one who asked about monthly, about how often they change the stocks? Somebody here asked about it. These are annually. The previous slide was monthly, and if you do it monthly, it turns out you do better by some reasonably measurable amount. The second thing is that these are now in thirds, so the universe of stocks that you have to look at here is much more extensive because there's some overlap. So there's also a wider choice here. You're not forcing yourself to take as extreme a position. But it does take an unfortunate combination of growth and value to really get excess performance. If you read across this table and you look at the value stocks with high growth rates, they don't significantly outperform the market. It's the ugly and boring stocks that really outperform. It's the two of them together. If you look over here and you just look at the expensive stocks that grow slowly, they don't significantly underperform the market. So it is the two indicators that have to work together if you're going to do less extreme valuations. So one of the real lessons of the statistics is that you have to be fairly careful about it, and you have to be prepared to look at extreme alternatives. That, however, is just history. If you're going to invest from now on, you have to believe that that history is sustainable. And what we talked about last time is the institutional, or yesterday, are the institutional and the individual psychological forces that look to be driving these statistical results that seem likely to continue to be true of the investing industry. And I talked about one set of experiments on the individual level. I would actually like to run an experiment in this room on the issue of loss aversion. Now, Joy, do we have the... No, I'll take it. You do one side of the room, I'll do the other. Okay, what I want you to do is read these choices. There are two choices at the end of the statement here, and I want you to write down which you would pick of these two choices. Actually, I'm getting a little short in this room. And the other side of the room is also going to get... So pass them down, and I want you to write down your choices, and this is really going to be audience participation. Oh, I know, you've got to get mine. Joy, you can't give them, you got to get mine. Here, sorry. You can't give them the other one. All right, have people written down their choices on this side of the room? Just quickly. And these are the experiments for which Daniel Kahneman got the Nobel Prize. The person he really did it with, who died before they awarded the Nobel Prize, was Amos Tversky, who was a psychologist at Stanford. All right, you should have all written down your choices. I want the people over here, I'll show you what the choices look like. I want the people on my right to raise their hands if they chose the $500 with certainty rather than the lottery. How many people chose, come on, you've got to vote. We're not going to do non-votes here. How many chose the $500 with certainty? If I wait here for a moment, we'll get the standard answer. It's about 95% of the people over here. And it is the right answer. This is a fair lottery with a $500 expected payoff and some risk. This is 500 with certainty. With no return to the risk, everybody should pick this, and about 95% of the people do. Over here, I want you to now actually raise your hands if you pick the minus 500 with certainty. It's much less. Why is that so striking? And typically only about a third in experiments of these people pick the $500 with certainty. These two choices are exactly the same. Here, if you win the lottery, you wind up with 1,000 plus 1,000, which is 2,000. If you lose the lottery, you wind up with 1,000. Here, if you lose the lottery, you wind up with 1,000. If you win the lottery and lose nothing, you wind up with 2,000. This choice and that choice are exactly the same. Here, you wind up with 1,500 for sure. Here, you wind up with 2,000 minus 500, which is 1,500 for sure. Yet how that choice is posed completely changes the answer. that investors give. What's going on in the second case is that people are confronted on this side of the room with a certain loss. To avoid losses, what people will do is take unreasonable risks. They will do irrational actions. And that is, again, shows up in this particular experiment and lots of other experiments. Classically, the way to avoid the process of loss in a stock, when you see the process of bankruptcy, and you saw it in this room from my friend here with the blue shirt, is not to buy those stocks. Once people are dumping stocks reflectively to avoid the possibility of loss, the prices of those stocks are going to fall below what's justified. In the terms we talked about yesterday, the person on the other side of the trade is not doing a careful calculation. And these results, again, have been sustained. They've been running these experiments since the late 1960s. And there has been no visible change in the results. They run them with medical students, they run them with law students, they run them with business students, they run them with money managers. They give people the money actually to make sure they do the choices intelligently. And the loss aversion that you see seems to be a continuing phenomenon. But if you doubt it, what you should do is obviously monitor these behaviors to the extent you can in society, and look at the institutional structure of the money management industry, which you ought to be familiar with, to see if these phenomena persist. I think all the evidence is that they do, and it's not a surprise that the value premia, the very small stock premia, have not gone away. Even though we now have funds that invest specifically in bankruptcies that have never been there before, that invest specifically in spin-offs that have never been before, it looks like these forces dominate those changes in the environment. All right, that's all I have to say, an extension of what we talked about yesterday about search strategies. What I'd like to do for the rest of the time is fill in some of the things that we talked about about valuation yesterday. Now really, this is your last chance to ask questions about these value-based search strategies. Yes?
Two portions of valuation. Excess returns to be gained. Were they done using real portfolios with real market prices, or were they based on academics?
No, they were done with the CRISP tapes, which are academics. But if you were here yesterday, what were these results basically validated by? If you looked at the performance of the big money managers who invest with a forward-looking perspective based on these kinds of things, they have typically reproduced these kinds of excess returns. The big value-based money managers have typically outperformed the market by about 3 to 4%. And if you look at the ones who are really good at valuation on top of it, the people like the Klarmans, by the way, we have a Harvard Business School classmate of Seth Klarman's here today, like the Seth Klarmans, like the Warren Buffetts. They typically outperform by 7 to 8 or 10%, like the Gabellis and so on. But there is a lot of supporting evidence that forward-looking, at least historically, investors have been able to obtain these returns with these statistical portfolios. In fact, there's a small tragedy involved in this. One of the people of the study that I showed you with the growth stocks and with the growth rates and the cheap stocks is a guy called Rob Vishny. He was a brilliant teacher and a great academic finance guy at the University of Chicago. On the basis of that, in the early 90s, they opened a money management firm. They made so much money that he since quit being a professor. So there are some people who have achieved both of them. I'm sorry, there was another question.
What's happened over the last 15 years to bring these studies up to date?
Okay, what they've done with the temporal studies is they've done these at windows of different lengths of time. If you look over the last 15 years, which is basically now from 1990 to today, these results are reproduced almost exactly. Looked at this window for the 15 years starting 5 years ago. We looked at it from 1984 to 1994. These results were actually reversed, although not by that much, that they didn't apply. And that's the only 15-year window that they didn't apply. That all other windows, and for every 20-year window, these results have applied. So there are going to be periods of time, most notably, obviously, in the growth market in the late 80s and the 90s, where they don't apply. But in the long run, they have been consistent. And I think the Japanese bubble, by the way, there's a period where they don't apply. So there are periods. By the way, the 1920s, the value stocks still outperform. It's only at the very end of the 20s that the glamour stocks for much shorter periods than the 15 years apply. But there are always going to be short periods where these results don't apply. It's just in the long run, for every 20-year period, they apply. Go ahead.
Another group that would probably appear high, concentrated in this area would be something like USG that has asbestos liabilities. How do they drop out if they actually stay in this sector?
They have corrected for stocks that are delisted.
Well, not necessarily delisted, they have lots of cash and cash flow.
Oh, no. If the stock is, these are, don't forget, these are based on observable accounting numbers. So USG will show as low, negative cash flow, and they're all in these, all the negative cash flow stuff.
They're not necessarily negative cash flow,
But
they have a potential.
Right, if they have accounting numbers that can be used to form these statistical portfolios, they are in there. No question. And if they have quoted stock prices to track their performance, they are in there, no matter what's going on, no matter how ugly they are. The problems that I think you'd worry about statistically is where stocks are delisted so that they fall out of the sample. But what they do with those is they obviously have negative 100% returns.
So you would own all the stocks or not have some?
Well, that's the tough question. I think that the evidence indicates that people who hold their noses and do that, and have done that in the past, both as active investors and as these trial runs, have outperformed people who've tried to get smart. And that's why I think the getting smart, which is doing valuation well, and I think realistically when you look at the really great investors, they all have some degree of industry expertise. I mean, Buffett has done extremely well in 3.5 industries and not so well in areas like shoes and currencies and metals. Those are consumer non-durables, which is Coke and See's Candy. And he used to have gum machines in the old days. Media and communications, he's a newsboy. He owns the Buffalo Evening News, did the Washington Post and ABC Cap Cities, and obviously insurance. So I think to do better than that, it's not a matter of, saying, oh, but what about, the asbestos liability, because that's going to be putting you in the group of people who avoid these stocks where the opportunities are. It's going to be saying, can I assess the asbestos liability so well that I can, among the set of companies with asbestos liabilities whose stocks have been really beaten down, identify the ones that are going to do better than the others. And I think to do that, you have to know a lot about a lot of things, in particular the industry, and that's what I'm going to talk about next. Sorry, there was a question over here, but if I answered it. Go ahead.
You said outperform the market, but what if we have a market right now that is actually a sideward market over a very long period of time, or even goes a little down and doesn't go anywhere? Isn't then the performance still not very satisfying?
Wow, look, the question is what's satisfying? And there's a famous quote from a well-known economist named Robert Solow. There was a CIA-affiliated research institute at MIT called the Center for International Studies that had an office in India that was closed. And the former head of that ran up to this guy whose name was Bob Solow and said, I got great news. We're going to reopen the CIS Institute in India. And Bob Solow said to him, well, what did the Indian government have to say about this? And this guy said, the other economist said, well, we haven't told them yet. And Bob Solow said, oh, that's terrific. Then I have great news for you. I'm going to have an affair with Sophia Loren. Now, the point of that story is that you live with what you've got. If everybody else is getting 0 and you're getting 6%, it may not be Sophia Loren, but over the long run, it's a lot better than what they're getting. So you cannot say, I'm going to be, because we know about market timing. There are not people who make huge amounts every year, including Warren Buffett, who's returned 23% a year, which is an enormous return over long periods of time. It is the nature of investing that you've got to live with what's out there. Gertrude, right? We can't all have affairs with Sophia Loren. She'd be really busy. Okay? All right, what I want to talk about next then is the issue of valuation that we talked on last time. You've got a lot of slides that are repeats of yesterday's slides. The standard approach to valuation, which is a ratio valuation. The modern substitute for that, which is a discounted cash flow. The reasons why that complicated discounted cash flow doesn't really make sense, because what you're doing is you're combining bad information with good information, and you're not using the assumptions that you can actually make. You're also throwing away information that's on the balance sheet. What the assumptions look like that you can actually make, which are strategic assumptions, and we're going to talk a lot about these after the break, and what the Benjamin Graham solution to this problem is, which is you start with what's tangible, which are the assets. When you value the assets, there is one critical assumption. Is this industry viable or not? The industry is not viable. You're going to value those assets at liquidation cost. In the Depression, when Graham started out, he valued all these assets at liquidation cost, essentially. If the industry is viable, then the assets are going to be replaced, and you're going to value them at reproduction cost. And what I'd like to talk about for a second next is what that process looks like. The nice thing about asset values is that you can just go down the balance sheet and value each item separately. We're not worried about this as an operation. If they've got $200 million in cash, it's easy to value the reproduction, both the liquidation value of that $200 million and what it would cost to reproduce. The liquidation value is almost exactly the $200 million, and this is, by the way, cash and short-term securities. The cost of reproducing it would involve putting $200 million in the bank, and that's both the reproduction value and the simple Graham liquidation value. What about accounts receivable? Graham was willing to apply them at book value, although in liquidation, you're probably not going to recover the full amount. You'll probably recover 90 to 95% of it, though. If it's a viable industry and your competitors wanted to reproduce those accounts receivable, well, how do you reproduce accounts receivable? You sell product to customers. And in that process, to produce $200 million in accounts receivable, you're typically, inevitably going to incur bad debt. So that the reproduction cost of those receivables is going to be something greater than the book value. At a minimum, you can add back an allowance for bad debt, which you'll see reported in the footnotes of any annual report. But this is not going to be a big adjustment ever. So that when Graham just took book value, it was probably a reasonable compromise in the 30s between liquidation value and reproduction value. What about inventory? Well, again, if you were liquidating, you'd write it down, But if you were continuing and you valued the inventory on a last-in, first-out basis, you're probably going to be undervaluing the inventory, because to reproduce inventory, you've got to do production. To do the production, you've got to produce it at a first-in, first-out basis. So if you've got a LIFO reserve, you could probably add it back, although it might be a little lower than that. But this is, again, going to be very close to book value. The hard assets to value are the ones below the current assets. Current assets, no matter how you do it, you're going to get reproduction values and pretty much liquidation values very close to book values. But what about property, plant, and equipment? How can you think about valuing that? Well, you do have, if you've got the financial information, you do have the original costs that were paid. For buildings, land, and construction in progress, do you think that they're ever going to be replaceable at less than their original cost? Almost never. So even just using the original cost for those categories of assets is probably conservative. On the other hand, for those assets, if it's a big part of the assets of the firm, that is the buildings and the land, what are you going to have to do if this is an important item? By the way, what Graham assumed in liquidation was he assigned 0 values to all of these. Just said, oh, well, this is the 30s, they're not worth anything. But if it's a continuing enterprise, how are you going to think about what the value of the land and buildings are? And the answer is, if that's an important issue and you see it here, you're going to send out an assessor to value the plant and equipment. In the U.S., for U.S. companies, the locations of all facilities are listed in the 10K. You can find out what they are. If they're important office buildings with a lot of value, and you want to do better than just the statistical approaches, you're going to have to send somebody out to value. If it's an ongoing plant, like an aluminum processing plant, you have to be sophisticated about the valuation. So, for example, there's a company out there, I think it's Novalis, which is a spin-off from Alcan. They've got aluminum plants. You could either look at the cash flow, which involves forecasting aluminum prices, or you could look at the value of the assets that are going to have to be replaced, which will tell you something about what aluminum prices have got to be to keep this industry viable in the long run. For that, you've got to be enough of an industry expert to go to engineers and know who are reliable engineers who will tell you what the cost of new capacity is per ton. And if you do that, the number you'll get, by the way, is about $1,500. The current earnings have a value of about $900. You would think that stock was a bargain. But nobody is building new aluminum plant capacity. That all the capacity, and it's essentially a huge potential capacity, comes from adding to existing plants. And the cost of capacity there is about $1,000 per ton. So you have to know enough about the industry to know the most efficient way of reproducing that kind of capacity. When you come to property, plant, and equipment, there you have the original cost. The difference between original cost and reproduction cost depends on the trends in prices for capital goods. Capital goods prices have been falling for the last 10 years at a rate of about 5 to 7% a year. So that the reproduction cost of those assets are going to be substantially less, even if they haven't worn out, than their original cost. Typically, if they're 7 years old and you take an obsolescence, a wearing out factor, plus this obsolescence factor and the fact that new equipment is cheaper, it's probably depreciating at close to 7% a year, so that you're looking at half or less of the original cost. Again, though, if it's a big item and there's doubt, this starts to be the area where you have to know a lot about the industry. Well, those are typically the real balance sheet items that appear. There are usually some other assets you can't do a lot with, various tax assets and so on. But then you've got to start to think about the intangibles. Companies have product portfolios. The value of those product portfolios, unless they've been acquired in takeovers, are not going to appear on the balance sheet. You've got to think about what it would cost to reproduce those product portfolios, because that cost is part of what protects the earnings of the company, among other things. Well, how can you think about the cost of a product portfolio? Ask yourself how many years of R&D it would take to reproduce it for an efficient competitor, and just look at their average R&D spending. If it would take 3 years to reproduce most consumer product portfolios and they're spending $150 million a year, it's $450 million to reproduce it. That's probably a reasonable estimate. If it's like the auto companies where it takes 6 years, and then you're going to have 6 years of R&D spending here. Again, you're starting to see, I hope, the degree to which to get a good reproduction value of the assets, you have to have available to you substantial industry expertise. You have customer relationships, trained salespeople and trained managers in the organization. You could ask how much they would cost to reproduce. On the other hand, there is a second observation that you have on these intangibles. And I'll talk about the one example where it's clearest. Liz Claiborne is a big dress and ladies fashion company in the United States. It's got a market cap, including debt, of about $4 billion. Obviously, their biggest asset is the brands. On the other hand, those brands can be created freely. There are no competitive advantages in the rag trade. So you could think about what's the cost of reproducing Liz Claiborne's brands. You could go to an expert who would say, I do business plans on new brand development all the time. This is typically the expenditure. It succeeds only a third of the time, so you multiply that expenditure by 3, and you've got a measure like that. On the other hand, Liz Claiborne and Jones New York and the other clothing companies buy brands all the time. And they pay private market values for those brands that are presumably based on a careful make versus buy calculation on the new brands. You can just look at a sample of those brands and see what they're paying in their acquisition per dollar of sales, or whatever the appropriate metric is, which is a private market value for the brands. And you can cross-correlate that with what your expert has told you about the direct cost of reproducing the brands. And the interesting thing is, we did that exercise. The numbers come out surprisingly similar. But what's reassuring is that you've looked at all the available data. So the further down you go, the harder it is to value things, the more creative you're going to have to be about bringing data to bear, and private market values on transactions are helpful supplementary data. In fact, to give our sponsor credit, Mario Gabelli is one of the first people who really began to look at that as a way of getting at asset values. But you're going to bring, because this is really an important theme in the Graham approach to value investing, all the information that you have to bear. For the liabilities, you can do complex calculations, especially on deferred taxes. You're not going to pay them right away. On debt, you could look at market values for equivalent issues because you have the full record of the debt. For accounts payable, accrued taxes, and accrued liabilities, they're going to look a lot like the current assets, and you might as well just do them at book. When you subtract from these assets the spontaneous or the liabilities, you get a net reproduction value of the equity. If you add back the value of the debt, you get a net reproduction value of the enterprise, of the capital of the enterprise. You can compare it to the simple Graham liquidation value, which is the working capital minus all the liabilities. He called that net working capital, and that might be a useful substitute for a liquidation value. But when you do this, there are things that you have to, this is just the difference between the two. You could use book, you could use gram, or you could do reproduction values. But when you do this, there are several things you want to remember. First, the nice thing about asset values is that they're a good way to think about management. Good management always adds value to the assets. It's not already embedded in the earnings. Bad management subtracts value from the assets, and if you're going to be buying assets and you've got bad management, you've got to think about getting rid of it. If you're going to use private market values, some of them are unstable. It's not as stable as the reproduction costs of these assets, directly estimated. So you want to cross-correlate it with other information, and if you're going to do multiples for private market values, as many people do, you've got to remember that those multiples can change very rapidly. There are people who are valuing internet subsidiaries at multiples of sales at the end of 1999. If you're going to rely on this kind of information, you really want a catalyst in place that will realize those values in the near-term future. You don't want to live with that kind of uncertainty. But the most important thing is to understand that book value by itself, whatever you think of the accounting profession and the conventions that people use, does extremely well in picking cheap stocks. If the reproduction value and the book value are not going to be very different, then go ahead and just use this. Where there are going to be big differences is where there are big intangibles, there is a lot of real estate, or there are technological trends that have either added value for environmental reasons or reduced value substantially from the property, plant, and equipment. But to do better than book, you have to know a lot about the industry usually. For non-viable industries, typically you're going to do a liquidation value. Are there any questions about actually doing an asset value? I mean, I can't tell you how to do it for particular industries. We've actually, at the Graham and Dodd Center, we decided that we needed to become industry experts. We took two industries, which are media and retail. We're in the process of trying to learn about those. But just the general principle of how you're going to go about computing reproduction values in a way that usefully adds to the information that's already there and has been statistically validated over and over again in the book value that the company reports. Are there any questions about that? Remember, the second thing that you're then going to do, if there are no questions about the asset value, is you're going to take a second look at value, which is from an earnings perspective, where you're going to focus on the company's earnings power as it's reflected in the company that you see there today without any growth. Why are you doing that? Because growth is where all the uncertainty in valuation lies, and you want to segregate that uncertainty from what you know. How are you going to calculate it? You're going to estimate an earnings power, and you're just going to multiply it by 1 over the cost of capital. It's less reliable in some sense than asset values because you've got to extrapolate. The mechanics of calculating this are you have to take accounting earnings and do adjustments to get earnings power. I'm going to talk about those adjustments in a second. You've got to estimate a cost of capital. Usually when you estimate an earnings, you're talking about the earnings of the enterprise. So you've got, if you want the value of the equity, you've got the earnings power value of the enterprise minus the debt, plus, by the way, any assets like excess cash that the firm has that are not essential to the ongoing operation. So you should not mistake enterprise values for equity values. Here you're making an assumption, which is that the current profitability is sustainable. Well, what are the adjustments to earnings that you have to make? Usually it's best to start with operating earnings. You've obviously, if this is a company whose operating earnings, as the accountants reported, are suspicious, you want to correct for that. Now, what suspicious earnings mean? If they have recurrent, non-recurring charges, so every year they have some non-recurring charge that they don't put in EBIT, you obviously want to charge them for the average level of those. You can't let them pretend that recurring, non-recurring charges are non-recurring. Secondly, you've obviously got to adjust for the business cycle. In the automobile industry, you could have losses this year. It does not mean that those firms have negative earnings power. In the business cycle, for capital goods industries, there are good years and bad years. You want to not look at the current year if it's at one of those extremes. You want to look at average earnings over the cycle for the firm as it looks now. And I'll talk about in a second one simple way to do both these things. Taxes sometimes vary. People run out of net operating losses. They have special events that cut their taxes, and so on. You want to look at an average tax rate, because remember, we're looking at sustainable earnings power. The amount on average the company as it is today could distribute every year and still be in the same condition at the end of the year that it was at the beginning of the year. Depreciation numbers today tend not to reflect true depreciation. True depreciation is what it would cost to put the company in the same condition at the end of the year as it was at the beginning of the year. Accounting depreciation is based on the historical value of assets. Which of those two numbers today do you think is higher, accounting depreciation or true depreciation? How many people think accounting depreciation is higher? How many people think true depreciation is higher? Accounting depreciation is higher these days. Why? Because capital goods prices are going down. In an inflationary environment where reproduction costs are above historical costs, accounting depreciation will understate true depreciation. But in an environment where replacement costs are below historical costs, the accounting depreciation is going to be below what you could distribute to shareholders and make the company whole, because you can buy cheaper capital goods, and you want to take that adjustment into account. Then, if you've got unconsolidated subsidiaries, unfortunately, you've got to go through the footnotes and do this exercise for them, and there may be other adjustments for a particular circumstance where you're an industry expert, where you say, for example, these guys are significantly underpricing their product relative to their competitors. They've started to correct that situation, and I'm going to add that, the benefits of that correction, to earnings power. The simplest way, I think, to do the cyclical adjustments is just to take historical averages. And here, the best device for doing that is value line. You start with the reported operating earnings for here 7 years. Then you add back the one-time charges. So if there are 0 one-time charges, the true operating earnings are going to be the reported operating earnings. Where there are one-time charges, where they've subtracted this sort of after the fact, after getting reported earnings, you've got to subtract it before the fact. and you get an adjusted earnings number. The next thing you want to do is convert that to a margin on sales, because these are the numbers, these margins on sales, that typically vary in a business cycle. And go ahead and you want this for enough years so you see the bad years and the down part of the cycle, and then just go ahead and average these margins and apply it to current year sales. And that should account for cyclical fluctuations here. You might want to adjust sales upwards if they're particularly depressed. Some industries have big sales fluctuations. Telecommunications equipment does. So you'd have to actually adjust the sales figures also. But autos and most consumer and other products don't. For a company like this, you look at this history, there's no clear negative trend. You look at the recession years, there's not a big drop in earnings. That average of 11.5% is pretty good. If you multiply that by forecast or current sales, say this should be a 14, almost 1496. This was from a specific example. This was actual sales. This was forecast. You get an average level of operating earnings. That corrects for both the cyclical fluctuations and the accounting fluctuations. It will also alert you to the extent that there is a positive or negative trend in operating margins. If there is, you've really got to sit down and think about whether it's likely to continue. And that's going to depend on industry conditions. What's the next adjustment you're going to do? It's usually in depreciation. What you want is maintenance or zero capital expense as the true measure of depreciation. Start with actual capital expense and subtract an estimate of the fraction of this over the last several years that's gone to growth. The simplest way to do that is just look at the capital intensity of the business, PP&E to sales. Say it's 20 cents of PP&E per dollar of sales. Multiply it by the dollar increase in sales. Once you get that growth capital expense, you can subtract it from the actual capital expense. It ought to give you an estimate of maintenance capital expense. Look at that over 2 or 3 prior years. You ought to get a good idea what maintenance CapEx is. If it looks ridiculously low or ridiculously high, you're going to have to talk to somebody in the company or the industry, and then subtract that zero growth capital expense from depreciation and add the difference back. That's a pre-tax number to get an after-tax number, of course. Ultimately, that's going to be taxed. For the moment, it's fully protected by the depreciation tax shield. For this part of earnings, you probably want to apply a tax rate that's half the average tax rate, because you're going from zero tax to full tax over time. Finally, you've got to estimate a cost of capital. How many people learn how to do that by estimating a cost of debt, a theoretical fraction of debt, a theoretical fraction of equity, and a cost of equity estimated by estimating a beta? Okay, if you went to business school, you learned to do that. That is an almost, in practice, complete waste of time, at least the equity part of it. Betas are estimated with errors of plus or minus 0.5. The mean beta is 1. So the actual beta could run from 0.5 to 1.5. The risk premium that you multiply the beta by, nobody knows what it is. Estimates run from 4 to 10%. So you could have half of 4, which is a 2% equity premium for an average firm, to 1.5 times 10, which is a 50% premium. It'll give you a cost of equity that runs from 6% to 21%. You can do a lot better than that. First of all, the cost of equity is always going to be above the cost of the debt. So that's a lower bound. Secondly, the most expensive kind of equity is what the venture capitalists have to pay. And if you read the venture capital magazines, they will tell you what returns they have to show on their old funds to raise money for their new funds. These days, that number is about 15%. So without doing any betas, you know the cost of equity is usually between 7 and 15, which is a lot better than the beta estimates. Usually for a low-risk firm with a lot of debt, the cost of capital is going to be about 7 to 8%. For a medium-risk firm, these days with reasonable debt, it's going to be about 9 to 10. For high-risk firms, it's going to be 11 to 13. You're a lot better doing that than trying to estimate using fancy formulas. So you get a cost of capital, and the nice thing about not including the growth is that errors in the cost of capital typically aren't going to be that big. If you're 1% off in the WACC, I'll come to you in a second, that's just a 10% error in the valuation, and that's not a killer error in valuation. Sorry, go ahead.
No, the assumptions you talked about apply well for developed markets, U.S. plus developed Europe. So what additional investments should I make for emerging markets, Brazil?
Oh, Jesus. That is a really good question to which I do not have a good answer. Estimating values for companies there, Jesus, lots of luck. I mean, let me actually give you what I would say, if I was in this business, what I'd do. First of all, unless I lived there and was an expert in those countries, I wouldn't try and do it. Because again, the other side of the trade is going to be a local expert, and so your search strategy will protect you against having to do that. If you had to do it, I would start just the way I did it, which is look at rates on debt. Look at actual, not theoretical debt ratios. Look at sort of what returns on equity funds are, and you'll get a number. People will say, I'm not putting money in that unless I get 25%. That means 25% is the cost of equity. In fact, the interesting thing about finance is that if I asked you what the cost of labor was, nobody in this room would have any problem. You'd go out and survey people and say, what would it take to get you to work voluntarily for this company? Well, the cost of capital is exactly the same. It's what returns do these local people or the international investors need to get them to be willing to put money into these companies. And it's sort of doing that kind of survey, which is going to be based on local information. But it'll be higher than for the U.S. or developed economies. Anyway, I have now a cost of capital. I have an earnings power. I multiply the earnings power. I get, by 1 over the cost of capital, I get an earnings power value. And this is the chart you saw yesterday. Now you're ready to really think about what the critical issues are. Is it the asset value that's there and management is the problem? In this case, growth is going to have negative value. Is it this case where actually the assets with the intangibles just match the earnings power, and I think there are no barriers to entry, in which case I have a good measure of value? Or is it a case like Coca-Cola or most of the big market cap firms where the earnings power is way above the asset value? And I'm going to be buying earnings power value. And there, these excess earnings had better be protected by barriers to entry. What I'm going to do is let you go now, because what we're going to talk about after the break, you have a bunch of other complicated view graphs that you shouldn't worry about, is we're going to talk about these situations. How do you judge when earnings like this are sustainable? And it makes sense to buy them and to buy the associated value of growth. So why don't you take a break now? I think they get 20 minutes.
Exactly. We have about 15, 20 minutes max. If you can try not to wander too far, that would be wonderful. And we'll see you shortly. We have coffee on the side.
No, it's that these excess earnings. All right, remember we talked about an investment process, which is a sensible search strategy, a good valuation technology. What, among other things, that valuation technology should do is it ought to identify what are the critical issues in any particular investment decision. What the Graham and Dodd technology of asset value and earnings power does is identify those critical issues, whether it's a management issue or whether what you're really buying is current earnings power. And the critical issue is that earnings power in excess of the asset value sustainable, and therefore is the growth going to have some value? And what I want to talk about for the rest of today is how you assess the sustainability of those excess earnings. It's if you buy the Buffett dictum of paying for good companies, how do you know what a good company looks like and whether it's going to stay a good company? Now, the classic way of doing that was to do a forecast of future company earnings. Now, we're on section 2. There are a lot of, in your books, there are a lot of view graphs I didn't use, which are just there for culture. Here, let me tell you what page you should be on. Yeah, session 2. It's 34-35. And what you did was you estimated a market size, a target share, which gave you revenue, operating margins, which gave you EBIT, taxes then affected that, and you had to subtract necessary investment, gave you cash flow. You applied an estimated cost of capital to that, and you got a net present value. And that was your idea of looking at the future of the business. It was looking at future earnings. The problem with doing that, or the problems with doing that, are things we talked about yesterday. That you're making a huge number of assumptions, most of which are buried in the parametric numbers that you're putting into your model. Assumptions about competitive responses, assumptions about the macroeconomy, assumptions about technology trends and input costs, assumptions about growth, assumptions about financial market conditions. And in the end, you may have assumed your way into investing in the Darfur of the economic world. And you would like, therefore, to step back and see whether where you've headed with the numbers makes broad sense, whether in broad terms this looks like a good business. And the most common way of doing that is really attributable to Michael Porter. That if you want to look at a good business, you want to look at the five basic forces that affect the operation of the business. You make a list. You list all sorts of pros and cons under those, and then you try and arrive at a qualitative conclusion to support your quantitative analysis. The real problem with these 5 forces, and how many people are familiar with that? Okay, a lot of people. It's a very common thing. For the purposes of analysis, the problem with 5 forces is it's basically 4 forces too many. And they're without priorities. You want to focus on what is the dominant force determining whether this is a good business or not. And in fact, in this list, there is one dominant force, and it is this one. It's entrance and expansion, which is equivalent to entrance by existing firms in the industry. Now, there is some sense in which everybody already knows that. If I talk about a commodity business, nobody worries about the competitive dynamics within the industry. Nobody worries about supplier power or purchaser, customer power. Nobody worries about substitutes. If this is the steel market, there is a price for steel. You have a current cost curve which includes some reasonable return on capital. If this is the situation where there are outputs in here at which the price exceeds the total average cost of producing that output, you're going to see what are above normal profits or economic profits. That's going to be reflected in returns on equity well above the cost of capital, say 20%. But in that situation, what's going to happen in that industry? Well, as night follows the day, people are going to expand. They're going to build new steel plants to take advantage of those returns, and that's going to be both new entrants and existing entrants. And as they expand, what's going to happen to that price? It's going to fall. As the price falls, profitability falls, and entry and expansion is not going to stop until the economic incentive to do it disappears. In commodity markets, the idea that anybody for any long period of time is going to make excess returns, that this is ever going to be for an extended period a good business, is one that people accept has a negative answer, that these are not going to be good businesses. Nobody's going to make above average returns for long periods of time. Forget any other forces. That the force of entry here is just going to eliminate profit opportunities. Well, in business school, whether it's undergraduate or graduate, what did they tell you is the answer to this problem? Product differentiation. You've got to differentiate your product. And as we talked about yesterday, they lied. It's not going to help. Now, if I asked you what the strongest brand name in the world is, if you were MBA students, what you'd say is you'd raise your hand and you'd say Coca-Cola. And I think to myself, when these students meet their future fathers-in-law, are they going to show up with a six-pack of Coke and expect to impress them? And the answer surely is no. So in classic differentiation terms, the strongest brands in the world are probably the luxury cars. That if I'm a South American or African dictator and I've just come to power and I want to impress people with the quality of my image, I'm not going to spend a lot of money on Coca-Cola. I'm going to run out and I'm going to buy myself a Mercedes or some equivalent luxury car. Yet if you look at the profitability of the Mercedes star, it has been meager for many, many years. In fact, there is even a locution in the United States about Cadillac products as the classic measure of differentiated luxury products that command a premium price. And General Motors has not made money for years. And that's not an accident. And again, we talked about this yesterday. What makes a product differentiated, or the consequence of a differentiated product, is you have discretion over the price you're going to charge. You can charge more and sell fewer units. In this situation where that's the demand curve for Mercedes and there's the cost curve, there are going to be outputs in which the price you can charge, which is determined by that demand curve, exceeds the cost of producing those cars. You're going to make economic profits. It's going to show up as huge returns on equity above the cost of capital. If that were the United States and this is Cadillac, what happens next? The Europeans all come to the United States. They see the opportunity to make that profit, and Mercedes, BMW, and Jaguar come to the United States. Now, prices don't fall, but at the old price up here, the amount you're going to sell is going to fall. Sales fall. As sales fall, you'll notice your average cost rises because your unit fixed cost is being spread over fewer units. Your average fixed cost is going up, and your overall average cost is going up. So what's happened, you're selling fewer units because you've lost business to the entrant, you're making less money on each unit, and your profits have gone down. And that's going to reduce your market value and your return. Well, when is that process going to stop? The Europeans have come in, and it's still profitable. Now who's going to come in? The Japanese. Acura, Lexus, and Infiniti, until that demand curve has moved so far to the right that you're making no basic economic profit again. The cost of product differentiation just offsets the benefits of product differentiation. People pile into the market as long as there's a profit opportunity, and they're just going to eliminate the profit opportunity in a different way. So the distinction between commodity and differentiated products is not the critical distinction. The critical distinction of a good business is not that there are differentiated products, but that there is something to interfere with this process of entry. And what that something has to be is a competitive advantage that incumbent firms enjoy. Entrant competitive advantages don't do anybody any good. Suppose we're in the cellular business, the guy with the latest technology in his network gets all the customers. Well, once he's entered and he's embedded that technology in his network, he just gets destroyed by the next new technology. So entrant competitive advantages don't make any difference. You've got to have incumbent competitive advantages, and fortunately, they are very small in number. One obvious one is that the incumbent has a lower cost structure than the entrants. So that when the entrants, even if they face the same demand, are just barely profitable up here, the incumbent with a lower cost structure is actually making money. So the entrant has no economic profit, entry stops, but the incumbent, given that lower cost structure, is still making money. And that is a competitive advantage that the incumbent enjoys that entrants presumably can't match. Now, what are the underlying circumstances that correspond to that picture? Well, one obvious case is the incumbent has a proprietary technology, either protected by patents or process research, or because it's moved down the learning curve and it's learned to have a lower cost structure than the later entrants. So proprietary technology is one possibility. The second possibility is that the incumbent has cheaper resources. It has cheaper labor than the entrants. Now there, you have to be very careful. Something that's often said is that, oh, well, we can destroy the current incumbents because they're unionized and we're not. That is not a competitive advantage that's sustainable, because you're not concerned with your high-cost competitors. What you're concerned with is your low-cost competitors, and if you can get in on an ununionized basis, other people are going to follow you into the market, and you're not going to have any competitive advantage over those entrants. So just because one other competitor or several other competitors are unionized and you are not, does not mean you have lower labor costs for the purposes of future competition, because it is your most efficient competitors that you're concerned with here. Second idea that you come across all the time is companies say, oh, we're just smarter and more agile. We just have better people. Is that an appropriate competitive advantage enjoyed by organizations? And the answer is obviously not. People are smart, companies are not. Companies, in fact, are entities made up of people. If the people are smarter, they can be, the bad news is, they can generally be hired away. And In the absence of some slavery-type relationship, there's nothing you can do about it. Either you're going to have to pay them what they're worth to keep them, or you're going to lose them. It's very rare that quality of labor or cheapness of labor is a competitive advantage. Everybody can go to China to make things. Being in China is not a sustainable competitive advantage. There is a second major resource that people talk about. They talk about, we have access to cheap capital. You hear this all the time, by the way, from investors. They say, well, you know, the guys on the other side of the trade are the guys who want low returns. And we're guys who want high returns, so we're going to make money on this trade. The only problem with that is, have you ever met an investor who says consciously, I'm a low return investor. I'm satisfied with doing badly. There are some cases where, for particular reasons, historically firms have had cheap capital because they raised it a long time ago. But suppose I have 4% debt. What's the real cost of that capital? I can invest it at a 10 or 11% return. For me to invest it in a business at a 4% return is a stupidity, not a competitive advantage. So that even if you historically have cheap capital, the real cost of that capital is its opportunity cost, and that's usually the same for everybody. So when people say, oh, we have deep pockets, the deepest pockets of all who said that was AT&T, and most of those firms turn out first they go through a cycle. They start with what they think are deep pockets. They lose all the money. They wind up with shallow pockets. And then, like AT&T, they disappear and get taken over by somebody else. So access to capital is almost never a competitive advantage. It is very rare that firms have superior access to resources. Even locations, timber, those are assets that can be bought and sold. They have opportunity costs, and they're not sources of competitive advantage.
Excuse me.
Yes?
This is probably a very stupid question, but I'm just trying to map onto this scale. Your average cost curve obviously starts high because you've got a certain amount of fixed costs being amortized over fewer units. Then it goes down at the bottom, then it goes up again.
It doesn't matter whether it goes.
Why is it going up?
Usually the argument for why it goes up is capacity constraints.
Right, but if you...
But if I flatten the curve out, is it going to make any difference to that picture?
Well, I just wonder if you could have scale as a
Hold that thought. We're going to come back to that. Okay, but what I want to make the point about is, because scale is going to operate in an importantly different way, is the difference between the position of the curves. It's where your whole cost structure is lower. Because I want you to think systematically about the separate ranges and sources of competitive advantage. Now, scale is going to be one later, but I'm going to want you to think about that separately for the purposes of clarity. So basically, you come back to proprietary technology of some form. And actually, that's quite rare as a competitive advantage. For very stable industries, the technology diffuses and everybody pretty much has the same cost structure. So in automobiles and things like that, there tend not to be proprietary technologies. In clothing manufacturing and retailing, there tend not to be proprietary technological advantages. In very rapidly changing industries, in high-tech industries, there also tend not to be proprietary technology advantages because firms tend to be experts in particular technologies. And as those technologies die and are replaced by other technologies, there are other firms that are experts in the virgin technologies. So in rapidly changing technologies, this picture is relatively rare too. It's in intermediate, complicated processes like chemicals that you usually see these kinds of advantages. Well, if lower cost is one category of competitive advantage, sorry, go ahead.
On the proprietary technology, when you're doing bottom fishing with small companies, I would think that would be a real
bottom fishing with small companies is usually a matter of a price that's below the earnings power value. It's not that the earnings power value is hugely in excess of assets. Because usually the companies that have these competitive advantages, with the exception of companies that I'm going to talk about in a second, precisely because of them, tend to be very profitable. They tend to grow, and they tend to have big market caps. So usually the companies in this category are not small, obscure companies, okay? Because they also have the resources to grow, and the growth is profitable. Well, the mirror image of a lower cost structure is that my competitors can't compete with me because I have access to demand that they can't match. That when the entrant is just barely profitable with small access to customers, the incumbent with better access to demand, with a higher demand curve, is making money, is showing high returns on equity. What's another way of saying that? Is that just brand image? No, it's not, because as in the Mercedes case, other car companies can reproduce the same brand image. What it means to say that I have access to demand that my customers don't is that I have captive customers. The competitive advantage is not differentiation, it's customer captivity. And that is the aspect of its brand that makes Coca-Cola such a powerfully profitable company. Because there is habit in drinking cola drinks that's reinforced by a very high purchase frequency. Why habits are powerful is something people don't understand. They're extremely powerful in cigarettes. They're extremely powerful in toothpaste. They're extremely powerful in cola. They are not so powerful in beer. Think about it. When you go to a Japanese restaurant, what kind of beer do you order? You order Kirin or some other Japanese beer. When you go to a Mexican restaurant, what beer do you order? You order Corona or Dos Equis or a Mexican beer. When you go to a Chinese restaurant, you order Chinese beer. How many of you actively look for Japanese cola in a Japanese restaurant? Or Mexican cola in a Mexican restaurant? For reasons that are absolutely apparent, the consequences are apparent, but the causes are not clear, people have a much higher preference for stability in cola drinks than in beer. And it makes them captive to Coca-Cola. Trying to displace Coca-Cola means changing those habits, which is expensive and difficult to do. The second thing that makes customer captivity is search costs. If you have a good relationship with a doctor or a professional service firm, and going to a bad alternative is very costly. So you go to a new cosmetic surgeon and you wind up with your nose in the middle of your right cheek. As a consequence of that, searching for a cheaper alternative is going to be very costly. So high value added, high complexity services are going to be subject to substantial customer captivity. And finally, for things like Microsoft, there are just large switching costs, because if you switch and nobody else does, you have difficulty communicating, you have to learn a whole new system of operating instructions, and you have substantial switching costs. So the second source of competitive advantage is just customer captivity, and it's due to either habits, search costs, or switching costs, and you can ask if that's characteristic of the company whose exceptional earnings you're paying for. The problem, though, with both of these sources of competitive advantage, that is lower cost structures and customer captivity, is, of course, that they apply to existing technologies and to existing customers. As those customers die, in the struggle for virgin customers or virgin technologies, there are no competitive advantages almost by definition. So the sustainability of these two sources of competitive advantage is necessarily finite. There is, however, one more source of competitive advantage. We haven't quite, by looking at demand and supply, exhausted the possibilities, and it was described by my friend from the class of '85, which is economies of scale. And economies of scale have two characteristics. One is that by themselves, they are not enough to create a competitive advantage. Now, I hope it's clear to everybody what I mean by economies of scale. That I mean a cost curve that basically declines throughout its whole range. Or it could be a demand benefit that as more people participate, like in eBay auctions, the greater the value of the product. So the lower the effective cost per unit of value delivered. The first thing about it is that if you don't have some small degree of customer captivity, or at a minimum customer inertia, when two people enter the market, this is going to be the picture. They're going to divide the demand essentially evenly, and the scale of the incumbent is going to be easily replicable by the entrant. So when you talk about economies of scale, where's my economies of scale guy? You can't just talk about economies of scale. It has to be associated with something that prevents the entrant from matching the scale of the incumbent, and that's some sort of either permanent or temporary customer captivity. The second thing about scale is that the market can't be too big relative to the necessary fixed costs. That if effective scale is 40% of the market, so to compete with IBM, you have to capture 40% of the relevant market. That is a high barrier to entry. If the market is so big that you can essentially amortize all the fixed costs with only 2% of the market, so you get down to the flat part of this average cost curve at very small market share because it's a big global market, then economy of scale advantages are also going to disappear. That's a sense in which globalization is the enemy, and large and fast growth is the enemy of competitive advantage and therefore of profitability. But if you have significant fixed costs relative to the size, and one of the problems with the internet firms is they don't have really big fixed costs relative to the size of their markets, so you can have a lot of entrants at small scale, and you have customer captivity, then you'll have economy of scale advantages. And they are wonderful to have because they apply not just to the old technology or to existing customers, but they apply to the acquisition of new technologies and the acquisition of new customers. And the best example to think about here is Intel. Intel is 10 times as big as AMD or Motorola. Intel has substantial customer captivity, actually. If AMD or Motorola comes out with a better chip, the customers from Intel, who are the big PC manufacturers, will typically not all desert Intel for AMD or Motorola. Because of the working relationships, because of the Intel inside, because of their belief in the ability of Intel to supply large quantities reliably, they will wait for Intel usually. So Intel has customer captivity. That means that when Intel invests in the next generation of chips, it can expect, if it succeeds, to capture 90% of the market. Motorola, when it invests in the next generation of chips, if it succeeds, can only expect to capture 10 to 15% of the market. that means Motorola can only afford to spend about 1/10 to 1/6 as much as Intel in pursuing the new generation of chips. And in that race, who is inevitably going to win when Intel is spending 6 to 10 times as much as AMD or Motorola? So generation after generation and generation of chips appear about every 18 months. Intel has been there producing either the best chip or a chip that's at least as good as the competitive chips, and that situation is not going to change. So a short series of short-lived competitive advantages combined with economies of scale translates into long-term sustainable competitive advantages. The same applies to Coca-Cola for the acquisition of new customers. Coca-Cola has big economies of scale in distribution and bottling because Coke is heavy and it's expensive to distribute. Coke has big economies of scale in advertising because advertising on television and so on is a fixed cost. They can expect to get a disproportionate share of the market of new cola drinkers. Just like Intel in the market for new technology, Coke can afford to outspend its rivals, except for Pepsi, by a factor of 6 to 10 to 1 for acquiring new customers. And if that's the case, who's going to win the struggle for new customers? The answer is Coca-Cola. So again, a demand advantage that otherwise would die as customers die, supported by economies of scale, translates into a demand advantage with succeeding generations of customers. The striking thing, therefore, is what makes Coca-Cola a powerful brand. It's not a quality image. It turns out, economies of scale and this peculiar characteristic that cola drinks have of significant habit formation and customer captivity. But when you think of economies of scale, the critical thing is to ask, what's on this axis? What is it that constitutes scale? Is it just big size? And I want to talk about an example that may actually not be so familiar to people in this room. Do you know what HMOs are? How many people here know what they are? All right, what they are is that in the United States, the way insurance is provided is that companies contract with a local health maintenance organization. That's an HMO. The HMO signs up doctors who are part of its network, and all the employees of that company have to go to one or the other of those doctors. Now, it turns out that HMOs have local presences. So if you live in the New York metropolitan area, 60% of the employees are signed up with a company called Oxford. Because 60% of the employees are signed up for Oxford, 90% of the doctors are signed up for Oxford. That means that Oxford has a lot more bargaining power, too, and gets lower prices from those doctors. If you're a new company signing up, who are you going to sign up with? You're going to sign up with Oxford. On the other hand, if you look in the United States as a whole, Oxford is a tiny company because it's only in New York. That Aetna has 10% in New York, 20% in Chicago, 20% in Dallas, 10% in Los Angeles, and as a whole, it has many more customers signed up. Who has the economies of scale advantage in that case? And the answer is, it's Oxford. It's not Aetna. It's because each health market is local in nature. That having a lot of doctors signed up in Los Angeles doesn't help you if you live in New York. You invariably get your health care in New York. The fixed costs of running that system are determined by your regional footprint. And the same applies to retailing, where there are economies of scale in distribution, in advertising, and in local hiring, but they have to do with local, not national market share. That's why when Walmart has come up against German retailers or Japanese retailers with large share in particular markets, Walmart has done very badly. That Walmart does well in markets where it's dominant, local markets where it's dominant. When it's done these big wholesale clubs, which is Sam's Clubs, actually Walmart is the least geographically concentrated of the three big wholesale club people, and it is the least profitable. So you have to understand what is the market size that determines fixed cost. In some cases, retailing, medical care, most services, it is geographic. That your infrastructure and advertising costs are fixed on a geographic basis, and economy of scale advantages are tied to geographic scale. In some cases, it's product lines. It turns out what Walmart's strategy was they dominated the South Central United States, and then they metastasized at the edges of that dominant market area till they occupied the whole of the United States except the West Coast, where Target had a powerful position and defended it effectively. The same thing happens in product space. If you think back to the history of the personal computer industry, Apple tried to do everything and were in fact the dominant competitors. Microsoft did only one thing. They concentrated in one area of product space, which was operating systems. They dominated that, and then they expanded at the edges of that, adding application software. Intel concentrated solely on CPU chips. So it's the particular product market that often determines fixed cost, especially when research and development is a big problem. Sometimes there are national, sometimes geographically there are global franchises, but they tend to be fairly narrow in product scope. The bottom line on what constitutes good businesses is good businesses are businesses with competitive advantages. Either captive customers, where you're going to see high prices and high margins, but that tends to shrink over time if that's all there is. Or proprietary technology, but that too tends to shrink over time and you benefit from low costs. The critical sustainable advantages are one of the first two combined with economies of scale in the relevant market. Now, somebody asked about small companies. The problem with big global markets is that when markets for things like cars were national, typically only a few companies could survive, and they all cooperated and made a lot of money. When the automobile market went global, all of a sudden a lot of competitors could enter at efficient scale, and you had the problem of the barriers to entry and profitability going away. You can see it with General Motors in the United States. In the 70s, its profit margins were, were 40% return on capital. In the 80s, they had a 28% return on capital. In the 90s, after globalization, they had an 11% return on capital. And today, they have a 6% return on capital, averaged over the 2000s. Size, big markets are very difficult to dominate. The companies that have sustainable competitive advantages are increasingly the ones like Microsoft and Intel and Walmart and Cisco to a certain extent that focus on narrow segments either geographically or in product space and dominate those particular segments. So if you wanted to look for companies like this that were not yet identified, what do you want to look for? You want to look for managements of, say, retail companies with strong regional positions in markets that are not well covered, and managements that understand this dynamic and are ready to expand around the edges of that region. Or companies in particular product niches where they can expand around the edges of those niches and preserve competitive advantages in the constricted markets. So what is the definition of a good business? If you're going to pay for above average returns on capital and earnings, what you're going to look for is basically sustainable competitive advantages that look like one of these three, but most importantly involve economies of scale and replicable, sustainable competitive advantages. Now, it's a very different picture of good businesses than most people are used to thinking of. There are a small number of other competitive advantages. Sometimes the government is your friend, usually not advertently. There are not going to be a lot of new entrants into the cigarette business. That means that there are barriers to entry that have been erected by lawyers and governments, and they can do whatever they want with prices, as any smokers in this room well know. In financial services, who knows what is critically important? If I'm a bank in North Carolina, or I'm a bank in southern Germany, and I have good relationships with all the local companies in that area, I have better information than Citibank or Barclays or any big global bank that comes in and tries to steal that business. Suppose they make an offer of a loan to one of my customers. Suppose the offer is one that I know, if the customer goes to them, will be profitable. That, in fact, it's a good borrower, it's a rate lower than mine, but it's still a profitable rate. What is the local bank going to do in that case? It's going to match Barclays, and it's going to keep that customer. Suppose the customer is a deadbeat, and for this customer, the rate is just much too low. Well, Barclays or Citibank is going to get that customer all the time. That's a fundamental barrier to entry, although banks still seem to love going into overseas markets and losing money. And if you ever read the geographic footnotes of the big global banks, with the exception to some extent of HSBC, you'll see that their foreign earnings are about a third of their earnings or their return on capital in their domestic core markets. That's a reflection in financial services of informational advantages that are very often intrinsically related to scale. So there are other competitive advantages, but they tend to be very specialized by industry and quite rare. The basic competitive advantages are proprietary technology, customer captivity, and behind them, economies of scale. And if you can't find those in your company that's making the excess earnings, or you doubt their existence, you're probably not going to pay for those earnings as if they were sustainable. Now, that's the basic theory. What I'd like to do with the rest of my time, besides taking questions, of course, is I'd like to just go through a cookbook about how, for a particular industry, you go about performing the kind of analysis that this theory of competitive advantage suggests. You're going to start with a clear picture of what the industry looks like here. You're going to start with an industry map, and I'll tell you how to develop that clear picture. If you don't have a clear picture of the structure of the industry, you're going to get in trouble. Once you get in trouble, you're going to mutter the magic word synergy, which is the investment banker's friend, and any respectable businessman or investor should put on a condom when they're dealing with it, and you're going to get yourself in terrible trouble. So you have to have a clear picture of the industry. Once you've identified segments in the industry, you're going to look at the industry history for those segments to see if barriers to entry existed historically, up to the present time. You're going to see if the evidence is consistent with the existence of barriers to entry. A classic case where it wasn't was Enron. Enron told a story how they were going to dominate the markets in trading energy and bandwidth. But if you looked at their historical returns on capital with all the lies, they were between 4 and 6%. 4 and 6% returns on capital are not consistent, and their returns on equity were 9 to 11%, are not consistent with enjoying sustained competitive advantages. So you're going to look at the history of the industry to see whether competitive advantages exist. You're going to then try and identify the nature of the competitive advantages, and you're going to see what that says about the appropriateness of management strategy and likely sustainability of those advantages and future profitability. Now, I'm going to do this analysis for the specific case of Apple. And this is data. This was first done in 1999. And Apple has finally, about 3 months ago, has recognized the force of this analysis, as you'll see. So we're going to start to think about Apple. And is that a good business or not? There are a lot of people who think it's a good business, and it's worth, therefore, considering that question. I'm not going to talk about the iPod now, although I'll be happy to talk about the iPod in a second. If you look at that industry, start with just a list of potential segments. Chips, I could break that down into CPU chips and memory chips, but for the moment, keep the number of segments manageable. You can always expand the number later. Chips, hardware, which is putting the machines together and selling them, the makers of software, and I could break that down into applications and system software. There are the network providers who in 1999, when we did this analysis, were dominated by AOL, and then there were the component suppliers. They're the people who make the screens, the power supplies, the disk drives, the printers, and so on. And there are a lot of segments there, and I'm going to leave them aside for the moment, but just as a segment to remind myself. So start with a manageable list of segments, and 5 is a good number, because Apple is a fairly complicated company to analyze. Once you have the list of segments, all you have to do is write down the firms in each segment, starting with the dominant firm. In chips, if it's CPU chips, it's Intel, AMD, Motorola, and Apple was also in that segment. They made their own CPU chips for a while. In hardware, who are the big names? Dell, Hewlett-Packard, and Compaq, they're now the same. Gateway, IBM, and Apple was in that segment. In software, it's Microsoft, Apple, Oracle. In those days, Netscape. Obviously, you'd have Google up there now. And finally, in networks, AOL, but you'd have Yahoo and a list of others. There's a huge number of Fireside. It's just a matter here of writing down names, starting with the dominant competitors. You're not going to do anything else. You're just trying to get a feel for the nature of the industry. But just doing that is extraordinarily revealing. What do you notice about these two sets of names? They have almost nothing in common. In particular, the dominant competitor is a completely different company. And the same is true of these two segments, and at that time the same was true of this segment. You're going to treat, therefore, each of these as independent segments. If the identities of the firms are different, especially the dominant firms, you're going to analyze each segment separately. You're not going to worry about synergies here. They look like very different markets. If the names were the same, so I had Coca-Cola parent and Coca-Cola bottling, then you